subscribe now and press the bell icon. Never miss an update.
Okay, PAL. PAL, you need to remember what is PAL. A lot of times now we'll be referring PAL only. So passive activity loss limitation rules. So let's read this. The amount of a loss attributable to a person's passive activities is allowed as a deduction or only to the extent of income or tax attributable to those passive activities. So loss could be limited. You can, the passive activity losses, passive activities income can be against each other. That restrictions on that. But one thing is sure, you cannot take them against the ordinary income. And whatever is not being deductible will get carried forward to future years. And the passive activity rules do not apply to C corporation. I hope you guys all know what is C corporation. Anurag? Yes, it's a general corporation. It's not a pass through. So now whatever rules we're looking into, the passive activity loss limitation rules, those are only applicable to individuals, even state trusts and all, or closely held corporation. Okay, they're not applied. What they're saying is they're not applied to partnership S corporation directly, but obviously they are applied to the individuals who own shareholding in those companies. So they do apply to the owner of these entities. So on the K1, if there is a loss of $100,000, you will see entire loss of $100,000 on K1 when it gets incorporated in the partner's return. It's not like the $100,000 gets reduced to 70,000 and say, okay, you cannot take more than that. No, nothing like that. The K1 will still show full loss. When you import it in the partner's return, that's the time we will need to check whether full $100,000 loss deduction is coming, or maybe it is getting reduced to certain other amount. So it definitely gets applied to the owners. And okay, let's see. What is a passive activity? That is the rental activity. Usually 90% of all rental activities will be considered as passive activity. Unless a person is running a rental business, then it's different. Or the person is like fully involved in some kind of real estate business and all, where they are like buying or leasing and subleasing and all those. Then it's a different thing. Then it works like a trade business. But if the main income is coming from a business, profession, some other business, profession, or salary, and on the side we also see rental income, it's not it's a no-brainer. It's definitely going to be a passive activity. And again, there the person should not materially participate. If it's a trade or business, then the person should not materially participate. Then it will be considered as passive. If the person is actively participating or materially participating, then obviously it becomes an ordinary income. So when you're doing Schedule C, there is a one question right on top of it. Does the taxpayer materially participate in this activity? What is Schedule C for? The Schedule C is for business income. When you're putting a Schedule C, that means we are telling IRS that this person, the taxpayer, has something related to business, consultation, contracting, or maybe one of those kind of income the person is having. And if we are claiming losses and we do not check that box, we will not be able to call the losses. Again, we need to be careful. Just because it is Schedule C, we cannot just go and just check that box. That person has materially participated. Why? Because we just want all the losses to come in. We still need to understand from client, how much did they really participate materially? What's going on? How much was their involvement? Was it some one kind of thing? Maybe they got one or two contract, they did some business, and that's it. Like maybe some consulting project they got, maybe you worked on it for a month or so and then finished it off. Doesn't mean that they have materially participated in that. Okay. So now what IRS is saying, that there are certain, pointers here certain tests, if any of those are satisfied, we can say that they have materially participated. How many hours that participants have put in? 500 hours or more during the year. Then participation constitutes substantially all of the participation in the activity. That means there is a substantial participation and all. Even if it's less than 500 hours, it is at least 100 hours. And then we need to see what are the other participants doing, like if there are any other individuals in that business and all. So for more than 100 hours and exceeds the participation of any other individual, if there are 2 or 3 partners, everybody is putting in, say, like, 120, 150 hours. Let's say the other two have put in only 100 hours, this person is putting in 130, 150 hours. Again, in that relative context, we can say that the person has materially participated. Then for any 5 years out of last 10 years, that it has to be done materially, or maybe any 3 years preceding the year in question, they have participated in a personal activity. Personal service activity would be mostly consulting, contracting, advisory, one of those kind of things. It could be any trading business. It could be just buying and selling something, or getting goods from some place and storing here and then selling it in the market. That could be a business thing. And the other thing is that participation is done on a regular, continuous, substantial basis for more than 100 hours. If any of those conditions are satisfied, we can comfortably say, okay. So what I was saying, okay, did we understand all these conditions or all these tests? Any of those tests, if they are satisfied, we can conclude that the person has materially participated. That's clear, right?
Yes, ma'am.
Okay. So passive activity rules do not apply to any active income. Obviously, if it's an active income, why will passive activity rules even apply? That's something very commonsensical also, but they're still putting it. Portfolio income. Portfolio income is the capital gains, stocks, selling, buying, mutual funds, all of that thing. Any casualty and theft losses, any theft has happened, or any kind of casualty, any, like, earthquake, because of the earthquake there is some damage, or the floods have like damaged home or office or whatever. So those kind of rules, I mean, those are not considered to be passive activities. So passive activity limitation rule will not apply. There are certain other rules, like this will be clearly capital gains. So how much losses, capital losses can be offset against gains and all, those are different rules totally. Maybe Shweta, can you read 4.14?
For 2019, Sally realized a 10,000 net loss, sales of $95,000 less expense of $105,000 from operating a sole proprietorship without regard to disposition of property other than inventory. The income tax returns also showed gross income of 5,000, that is 2,500 of wages, 500 interest on personal saving, and $2,000 long-term capital gain on business property. 2,000 long-term gain on business property. Okay. The excess of deduction over income was 18,200. That is 5,000 gross income minus 10,000 loss from business operation minus 1,000 non-business short-term capital gain on the sale of stock minus 12,200 standard deduction.
So we are seeing that this $5,000 gross income, $10,000 loss will reduce that income. There's another $1,000 of non-business short-term capital loss on the sale of stock. I don't think they've mentioned it anywhere here, but let's assume it is there. Okay, we're not going to focus too much on this, how the calculation is done. Minus 12,200 standard deduction. So the point to note here is that this is a business loss and it is not a passive loss, and that's why she's able to offset that business loss against other income. Can you read this last paragraph?
Because she does not engage in the business outside of occasional business consulting, any income or loss derived from the business is passive in nature. Therefore, any loss derived from the partnership may only offset passive activity gains. But where from this has come?
No. There is a problem here. I think last time also we saw that there is no There is no partnership here. I think just reduce, like just ignore this part. Okay. Let's not pay attention here. What we are trying to say is that she's running a sole proprietorship. This is clearly an active business. And they didn't even mention where did the partnership come. I think there's some
I
typo,
think
some.
in this, in connection to the previous question, no, this is Sally. No, not that, but.
No, I don't think these are related.
Mhm.
Yeah, no, I remember last time also we had this issue. So just leave it. Okay, just forget about, ignore this part. What we're trying to learn from here is this is an active business, and that's why she'll be able to take entire $10,000 of loss and offset other income. So if you see, if you put anything in Schedule C and if you mark that the taxpayer has materially participated, that Schedule C losses will be able to reduce other income on 1040, which could be wages, which could be interest, dividend, or any other income. Okay. Next one, Divyansh, you want to read?
Yes, ma'am.
Kathleen, okay, go ahead.
Kathleen, in Argentina, she had a business equipment with a FVM of $15,000.
What is this? What is this? What did you say?
FMV,
What does that mean?
fair market value.
Good. Yeah.
On the basis of $20,000, Stolen had a business computer with FMV of $1,000 and adjusted basis of $500. Completely destroyed by a storm, she did not have an insurance on this asset. Catherine is able to deduct a loss of combined adjusted basis because the assets are business assets equal to $20,500 and 20,000 plus $500. If the same assets are personal use the assets rather than the business assets, the loss would not be allowed as a deduction unless the loss was attributable to the federally declared disasters.
Yes. So what they're trying to say that, her business equipment got destroyed in something, right? Okay, by a storm. So she's running a business. She's a vet. Her business equipment got destroyed. Maybe there is a storm. The tree fell on her office or something like that must have happened. And in her books, the fair market value of her equipment, business equipment, was $20,000. Sorry, basis was $20,000. The fair market value was probably a lower amount. And then there is another computer where the fair market value is higher, basis is low because probably more depreciation has been taken. Okay, so that becomes a basis. What is she able to write off? Because, first of all, because it's a business loss, she is able to write off. Now, how much will she write off? IRS is saying, well, in your books, you had a value of $20,000, you had a value of $500. So you write off entire thing, 20,000 plus 500. If this was a personal computer, if they were like same storm had destroyed her house, and if let's say the fridge got destroyed or dishwasher or something else, she would not have been able to claim because obviously that's not business equipment. Okay, unless it was attributed to federally declared, meaning that there might be, like, if the disaster is so huge, the natural disaster, federal government might come and say, well, the people have been really affected, so we will give them some kind of relief. If that is the case, then yes, personal losses can be taken. Otherwise, usually we'll not be able to take any personal losses for deduction purpose. Clear? So rental real estate, now let's look into this point. Typically, all rental activity is passive. Up to $25,000 of a tax year loss from rental real estate activities is deductible against any other active income. But again, yes, that's allowed, but there might be some phase out limits. If the AGI is above certain limit, above certain point, then this 25,000 may get reduced to say 12,000, 10,000, and all. Okay, this is what they're saying. The $25,000 limit is reduced if the AGI is over $100,000. And in that case, obviously, the losses will not be allowed and we can carry them over. There are certain exceptions to this rule. If the taxpayer is actively participating in the rental activity, then obviously this will not be considered as a passive loss. He owns 10% or more of the activity by value for the entire year, and has an modified adjusted gross income of less than $150,000. So again, there might be a question when we are putting like how much is the ownership. If it's just 1 to 5% ownership, again that person is not a very active investor. So but both the conditions have to be satisfied. The AGI also be less than certain limit, then they may get this deduction. Otherwise, there will be no deduction for rental losses. Vandana, can you explain this thing? 4.16, go through it. And this is where we are talking about rental real estate activities.
A taxpayer has wages of $30,000, $5,000 gain from a passive partnership interest, and $35,000 loss from active rental real estate activity. The taxpayer may first offset the passive gain, that is $5,000 with $5,000 of the passive loss, with the remaining $30,000 passive loss. $25,000 of the non-passive gain, that is wages, may be offset.
Yes. So what they're saying is, so first of all, we know that adjusted gross income is very low for this person, definitely not more than $100,000. Because all they're having is like 30,000 of wages, 5,000 from some other partnership gain, and then rest of the $35,000 is a loss from real estate activity. So what we'll do is first this $5,000 of passive partnership interest gets offset against this loss. Now she's left with $30,000 of loss, or she or he. So out of that $30,000, she should be able to take $25,000 against the non-passive gains, because the AGI is very low, so she's getting that benefit. If the same time, if we say that her income is $130,000, this will not come up as a deductible. Okay, so these all things will happen automatically in software.
I'm one doubt.
Yeah.
Ma'am, as you said that if his or her wages was $1,30,000, then 50% would apply or not? 50% of dollar 25,000.
What is 50,000?
50,000.
Where do you see 50?
Ma'am, example 4.16. As you said, ki if her wages was $1,30,000, right?
Mm-hmm.
Then you said that dollar 25,000 would not be deducted, yeah, would not be offset.
Correct.
But is it 50%? Because since the AGI is more than 1 lakh, so 50% of dollar 25,000.
Right. And yeah, you can put it that way, because $150,000, if we say that this is 150,000 plus, then
Yeah.
nothing will come up. Okay. But then, yes, up to $100,000, then maybe 50% can be taken.
Yes. Okay.
Yeah, that's a good point. Okay.
Okay, ma'am.
So, okay, now we'll see what is active participation. Right now, we saw what is material participation. So, there is a difference between active participation, material participation. Active participation is a less stringent requirement than material participation. Okay, there are certain things here, like, I mean, if we will not just go over this thing, there will not be active participation if the ownership is less than 10%. And including the spouse interest. So if the husband owns 5%, wife owns 7%, definitely, like, adding up both of them, they're crossing 10%. So in that case, we can say that yes, they are actively participating because it's more than 10%. See, another thing is we all know that we are filing returns jointly in US. So we are going to add up their interest. If it's in the same company, then we need to add up what is the total interest which is being held by them. Okay. And that's fine. And then there are certain other like real property trade or businesses. If you're doing a real property, I mean like real estate trade or business, then obviously like, those losses can be taken. Again, there are certain things that more than 50% of the time of the individual services should be towards this renter, towards the real estate business. Usually we'll say that real estate is passive in nature. But if we can prove that more than 50% of the time is going in managing this real estate business and all, and or if we can prove that the individual is putting in more than 750 hours a year into managing this business, then we can say that this is active business. And this provision also applicable to closely held. So okay, there's something called closely held C corporation, which is more like a S corporation and LLC. So all the rules which are applicable to LLC, S corporation, they're also applicable to closely held C corporation. We don't see much of that, but then it is different than regular C corporation. Okay. And if 50% or less of the services performed are towards rental or towards the real estate and all, then we will say that the passive activity rules will come into the picture because it is not going to be active anymore. So what we need to remember here is broadly what we need to remember is the person actively participating, which means do they have more than 10%? As we saw that active participation is not as strict as material participation. So maybe if they are owning more than 10%, it could be considered that they are actively participating. Or if we are just specifically talking about real properties and all, then maybe 750 hours of time should be going there, or at least 50% of their time, whatever they are working, 50% of that time should go towards managing this business. And anyways, all these losses which are not allowed, this is the same point we have seen that if it's not allowed, it can be taken forward to a subsequent tax year. It can be applied to next years and all. Okay, it can be treated as a deduction in next year. But there is an exception there. If we are closing down the business, okay, let's say there is some passive partnership business the person is involved in, or a rental business. Okay, and then the person decided that okay, in year 2022 I'm not going to rent it out anymore, I'm going to use it for my own purpose. So that rental business is closed. So there is a little box again in the software where it says, is this the final year of this business? If we mark that, that means this is completely closed, or the K1 would have final year marked on it. In that case, what happens with the losses which are sitting there on the tax returns? Obviously now what IRS is saying that okay, if you're just closing down this activity, there is nothing going to come in future. So where will you apply those loss against? So maybe just take all the losses in this year, in the year where you're closing down the business, and they become fully deductible. Okay, and actually those losses become fully deductible. They can also offset the other regular income if the disposition has happened. That means that will be the final year of that passive activity. That will be an exceptional year. Okay, this is what they're saying. The remainder of the loss, if any, is treated as non-passive. If it's treated as non-passive, meaning it is treated as active. So active loss can reduce active income. That's again only an exceptional thing that usually doesn't happen. All the losses will get carried forward. But if the taxpayer comes and tells us, well, this is going to be my last year, I'm not going to do this business anymore, I've incurred enough losses, enough is enough, and all these things, I'm going to close it down. If that is the case, then we'll also have to make sure, again, if you're doing that kind of return and we know that this is going to be the last year, and you see the losses are $100,000, but on your 1040 you don't see that much loss coming and offsetting other income. That means we are doing something wrong. We'll have to again go back and check why the losses are not coming up. Maybe we forgot to mark the final, year box there, that this is the final year for this activity, or the complete disposition box has not been marked, because it has to come up. There is no other activity which will happen again in future. So what will the taxpayer do with those losses? They'll keep sitting for 10 years, or maybe he'll have to compulsorily start planning something, that okay, let me start another passive business so I can use those passive losses. That's unreasonable. That's not even fair. So IRS is saying, fine, in that case we'll allow you. We'll just go over this example now. Okay, this is yeah, and then we'll talk about business law. So let's just finish up this thing. Siddhabi, can you try to read this?
Yes, ma'am.
Here, if you guys remember, a couple, like maybe like I don't know, a few classes back, we were talking about what is the rental use test and what is the personal use test. Does anyone remember how many days?
15 days?
Yeah, 15 or 14 days.
Yeah.
14 days, right? So if it's rented for more than 14 days, or if it's used for more, personal test is also there. So how many days it has been used for personal purpose. So that will help us decide whether we should take that property as a personal property or as a rental property. Okay, so this example is based on that. Go ahead, Siddhabi.
Jack owns a vacation apartment to Miami Beach. He rents it out to vacationers most of the year, but uses it himself a few times each year. In each of the following situations, Jack has a different ability to deduct expense based on the amount of personal and rental use. Situation 1. Jack uses the apartment for 4 days and rents it for 200 days at a fair rental value to unrelated parties. In this situation, Jack passes a rental use and personal use test and is able to take all the deductions applicable, subject to the passive loss rules. And then situation 2, Jack uses the apartment for 24 days and rents it for 165 days at a fair rental value to unrelated parties. Jack passes the rental use test but fails the personal use test. Because he personally used the rental for the greater 14 days or 10% of the rental days, therefore Jack must allocate the expenses between the rental use and personal use and may deduct rental expenses to the extent of rental income. And situation 3, Jack uses the for 10 days and rents it for 10 days at a fair rental value to unrelated parties. Because he fails both the personal use test and rental use test, he does not need to report the rental income, but he may not deduct the related rental expenses.
Okay, so let's talk about that. What is happening? So first of all, we need to pay attention. This is a vacation apartment. This is not a regular apartment in the middle of the city and all. Usually, if it's there in the city or some other place, it would be always rented out. So what they're saying, it's a vacation apartment. That tells us that maybe we need to understand better whether this is really still a private property, or it can be used as a rental one. So situation 1, Jack himself is using it for 4 days, and Jack is renting it for 200 days. So here, what is happening? He's renting it for 200 days. So Jack is passing the rental use test, and that's why he will put all that 200 days income as fair rental income, and he should be able to take all expenses as a deduction. Okay. Now, second situation, what is happening, that he's using it for 24 days and rents it for 165 days. This is important to unrelated parties and all. On purpose, they're saying it so that to just tell us that don't get confused. This is all he's giving it to, at arm's length, he's doing all this transaction. So Jack passes the rental use test but fails the personal use. The personal use is also 14 days or maybe 10% of the rental days or something like that, if you remember. because he's personally used the house for greater of 14 days or 10% of rental days. So how much days he has used it for? 24 days. 24 is obviously greater than 14, or 10% of 165 days. So that becomes 16.5. That's again lower than his personal use. So what in this situation, what is happening is he's using it for enough time for personal use also. This situation, clearly his personal days are very, very low. He's not passing that, the test that he should be using it for more than 14 days. So it's very, very apparently we can tell that okay, just take that as a full year rental income and all the expenses can be deducted. This could be a bit confusing because he's renting it only for 165 days plus he himself is also using. In that case, what IRS is saying that it's fine, you just allocate the expenses between rental use and personal use. Allocate, if you're paying $10,000 towards property taxes, take a proportion towards personal days. So meaning $10,000 will not fully be deductible. Maybe amount corresponding to 165 days, when you take a ratio, maybe it comes to $8,000 or something, that could be deductible. So what we are doing is we are allocating the expenses. To the extent of rental income, obviously the expenses can be higher, but they will get carried forward. Now there's situation 3, Jack is using it for 10 days. He's not using it for 14 days. Okay, he's not personally using it for 14 days. And he's renting it for 10 days. He's not even renting it for more than 14 days. 14 days is the number that we need to remember. So hardly he has used it for himself for 10 days. Maybe for 10 days he just rented out to some people. Rest of the time, completely the apartment is vacant and is just locked and is just unused. So he's failing both the personal use test and rental use test. That means he cannot take any deduction and he's not even supposed to report any rental income. He might be earning some income for 10 days, right? Because he's renting it. Maybe he's earning $10,000, $1,000 per night, something like that, or $5,000. But there is to make it simple, uncomplicated, what IRS is saying, fine, you're renting it for less than 14 days, don't worry about it. Whatever it is, just keep it with you. You don't need to report any rental income. And this is logical, right? If he's not reporting any rental income, why will IRS allow to deduct the expenses? He cannot go ahead and say that, well, I'm not reporting any income because I'm renting it out for less than 10 days. But I'm actually spending $20,000 to maintain the apartment, so let me take a reduction for that. Doesn't work like that. It has to be fair. So these days are important. Whenever we do Schedule E, Schedule E is for rental income. When you start working on a Schedule E, there will be certain basic questions that the software is going to ask. And couple of the questions are for how many days the property was used for personal purpose, for how many days was it rented out. There are little boxes there, we need to put the numbers there. Then the software will do this calculation and see how expenses need to be allocated or what is allowed, what is disallowed and all. So it's very important when you're working on Schedule E, please do not leave that blank. You're probably thinking it doesn't matter, just leave it as blank. Don't even put anything. It may matter. So try to fill up everything. Try to answer it all properly so that we get the correct calculation done. Because now these are not the days, we don't work like this, right? Not anymore. Maybe 20 years back they used to do like this. They will do it all on paper and they'll see what it is, take the ratio, split it up, all those things. Nowadays we are using software, so we are not doing it. But what now becomes important is feeding the right information there. If we are not putting in the right information, the calculations will all be wrong. And these days people don't even understand thoroughly because we are so much used to use the software, will probably not even understand that there's something wrong being done there. Okay. So yeah, let's read the next one. Hemant, PAL limitation. There is an active participation.
Yes, ma'am. The line is a single taxpayer has a 70,000 in wages and 15,000 income from the limitation partnership and 26,000 loss from real estate activity, which is she actively participated, and it's not subject to modify adjusted gross income. The phase out rule. She used 15K of her 26 loss, offsetting her 15K passive income from the partnership, and she actively participated her real estate activities. So she can use remaining 11K as a rental real estate loss, offsetting her non-passive income wages.
Yes. Is that clear? Garima, is that clear?
No, ma'am, I'm just trying to get it.
Okay. This was the question that you asked. Will she be still able to take
Yes,
$25,000 deduction and
yes.
all?
Hmm.
Hemant, can you try to explain it? What is happening here?
A single taxpayer having a wages of 70K and a 15K income from partnership.
From a limited partner. So usually that she is having 70,000 in wages, that clearly tells us maybe her major income is coming from being a salaried employee. On top of that, she's having some partnership. Maybe she has put in some money and all, and she's getting this much income. This looks like this is a passive partnership share. Okay, next.
26,000 loss from rented real estate, which she's actively participated.
She's actively participated, meaning she is more than 10% owner, or she has put in more than 750 hours, or more than 50% of time, and all those things. So maybe there are certain criteria, but clearly they are saying that she's actively participating in that. And if she is actively participating, she gets $25,000. Where is that? Yeah, where was that thing? Yeah, here, $25,000 tax year loss she can deduct against any other active income if she is actively participating, or if her income is above certain, below certain level and all. So again, let's go back here. So her losses are $26,000. First of all, I mean, logically, if you see if there is a passive loss, first see what is passive income, offset against each other. The $26,000 loss will reduce this $15,000 of income. Then there's still $11,000 of loss left. Because she actively participated and because her AGI, she's not subject to the phase out rule. That means her AGI is below the level, whatever has been given by IRS. So she is allowed to reduce her ordinary income by that remaining $11,000 of rental loss. So her wages will become like $59,000 or something, and she'll have to pay taxes only on that.
Yes, ma'am. Now got it.
Got it now?
Yes, ma'am. Yes, ma'am.
Good.
Yes, ma'am.
Now the anyone has any question, we'll take a couple minutes break if you have, because now we're done with the passive activity loss limitation point topic, and we're gonna start with something else. I hope everyone is getting it, huh? I have few set of questions that we're gonna do later. So we will do a test on this chapter and all the other previous chapters also. Okay, let's go to the next one now. What time is it? It's already 6:08. Okay. Excess business loss. So what they're saying is business loss typically business loss is all deductible, because we are saying this is an active business loss. So or the person has materially participated and all, usually Schedule C losses will offset any other income. Those are not considered to be passive loss. But what IRS is saying, they will put a cap on it. They'll say, yeah, fine, we are allowing you to deduct that loss, but it's not like you can deduct anything you want to. It's not going to be infinite. So we'll put a limit on that. What is that limit? That limit is very high. That's why a lot of the times we are not even like, we don't even realize that there is a limit when we do the tax return, because the limit is $250,000 for single person and $500,000 for married person. That's a big limit. So like if you're reporting a Schedule C loss of $500,000, that's typically that kind of big loss will not come on Schedule C. Usually people will go and form a S corporation or LLCs and all, and those losses come from LLC. Very rare, but it's possible. So what IRS is saying is, yes, you can deduct it, but if there's something called excess business loss limitation, and we are not going to allow you to deduct more than that. Remaining losses can be carried forward and you can use them next year. But again, there have been changes in net operating loss from last, when did it change, Shweta? 2021 onwards, I think. Tanya, right? Yeah. So only 80% of the losses can be, only 80% of the taxable income can be offset against carry forward losses. So whatever happens, this is mostly like minimum taxes, AMT or MAT, whatever you want to call it. So even if there are millions of dollars of losses sitting, but what IRS is saying that you offset only 80% of your income against that loss. So pay taxes on at least 20% of the income. IRS wants some revenues. They're like, okay, we'll change the rule. First, they had allowed 100%, but because the companies are reporting so much losses and all, they're putting like, okay, pay 20%. You can only offset 80% of income against those losses. So let's go over these examples and then we can, we'll understand it better. Anurag, loss carry forward.
Loss carry forward. Blaine incurred a large business loss during 2019. Blaine is able to carry his losses forward indefinitely, offsetting taxable income as it becomes available.
Right. Right. Tanya, you want to go through 4.20 and also explain it?
Ernest, a single taxpayer, earns 600,000 of salary income. He is also a shareholder in an S corporation of which he is a material participant. His share of S corporation loss for the year is 325,000. The pass-through of the S corporation loss is limited to 250,000, so the remaining 75,000 loss becomes an annual carryover. 600,000 salary minus 250,000 allowable S corporation loss, 350,000 is the AGI.
Right. So it's not just Schedule C. There is also a limit on pass-through. If the income is coming from a like active source. If he was a shareholder in a S corporation where he has not actively participated or where he has not materially participated, then passive activity loss limitation will come into the picture. But what they're saying is he is a shareholder where he is materially participating. That means his involvement is quite a lot. And through that company, he is getting a loss of $325,000. And he's single. It's single, so the $250,000 limit will be applicable to him. So he cannot carry, even though it is active now. We are not saying that S corporation loss is passive. It's completely active. You should have been able to take, but IRS is putting a limit on that. That, the whole intention is that pay some tax. So they are putting a limit. They're putting a threshold that you take only $250,000. You reduce your other salary income or whatever income you have and pay taxes on rest of it. Remaining 75,000, you take it in next year.
I have a question.
Mm-hmm.
So that S corp limitation loss of 250,000 changes like standard deduction every year, or it is fixed?
No, No, standard deduction is going to be fixed only because see, these are
No,
all
no, standard deduction amount changes every year. No, they change the threshold, right? So the 250,000 also is 250,000, or it changes like to
we are
260
talking
or
about this
270?
$250,000 of loss. What are
Yeah.
you talking? No, typically this does not get changed every year. When we are talking about the standard deduction or other small items, those they get changed like every year, like IRA limits and all those, they may get changed. This is still 250,000 and 500,000.
Excuse me, ma'am.
Yes, go ahead.
Ma'am, I would ask, this carry forward of losses is for indefinite period?
Yes,
Okay.
they said somewhere, yeah, business losses can be carried forward indefinitely.
Okay. But no number of years are limited.
No, no.
That loss will be married filing jointly. It'll be different, is it? It'll double up?
This is what it is. Tanya, can you see the screen?
Yes. Okay. Got it.
So you're right. It gets doubled up. Okay. Last topic here, then we'll close on it. So this is something called wash sales. I think everybody should know what is wash sale. Someone wants to explain what is meant by wash sale? Tanya, maybe you can only explain.
When you actually make a sale of a stock and you get a loss on it, but within a stipulated period of time, typically within 30 days, if you buy that stock or bond again, then you don't get the loss that you got from the first trade. That is what
Right,
is
right.
it correct?
Yes, that's correct. So the whole idea is what is wash sale? That's something when you're buying and selling the same stock within a period of 30 days. It looks more like a trading activity than an investment activity. So what IRS is saying, if you're making a genuine investment, will allow you those capital losses and all. But if you're buying, selling and all, and continuously doing that, that becomes more of a trading or wash sale kind of thing. Those are not allowed. I'm not sure, Shweta, is there a rule in Indian Income Tax Act as well against wash sale losses?
No, nothing as such.
So one can deduct all the losses?
Yes.
Yeah, so IRS doesn't allow that. This is again a way to discourage the trading activity. Probably the more focus is on just the investment or not speculation rather. So yeah, you're right. It's like within 30 days, if you're buying and selling the same stock, then it could be considered as wash sale. So when we are looking into 1099, 1099 is the statement that we get, right, which will tell what the taxpayer has sold during the year. So there is a separate column there. In that, they will put W. That's some code will be there. So if the W code comes up, that means what they are telling us that this is a wash sale. So if there is a loss because of that sale, it's not deductible. And when we are putting that the same thing, same information in the software, if we forget to put the W thing, then obviously our numbers are not going to match with IRS. We'll get a notice saying that this is not deductible. How did you do this? So it's a very small code which is written there. So when we are going through it, let's pay attention. What is the purchase date, sale date, cost basis, sale price? Okay, then also look into the code. If there is something called coming over there, you have to put that there in the software. We don't have to do that manually. Automatically, those losses will not be allowed. Okay. So let's go through this example. It will be very clear. So he bought it in year 1. Fred has bought something, 100 shares, some price. Year 5, he was holding on until then. The prices went down to 25. Well, he's thinking that let me just sell it off. Let me book some losses. At least I'll be able to take the losses and apply against other gains, other capital gains. So he sold off 100. And his wife then, he sold off on July 28th. Within 10, 12 days, on August 10th, His wife Laura purchased another 50 shares of the same stock. I'm sure he must be getting mad at his wife now. Why did she purchase it? Right? So because she purchased it, and this is all happening within 30 days, he doesn't even have any knowledge, or he has it or whatever. But IRS is saying, well, we cannot, consider both of you as different. You purchase, your wife purchased the same thing. Because she purchased 50 shares, now we are not allowing you a loss of 40 minus 25. How much does that come to? $15 times 50 shares, because she purchased 50. So that's $750. This is not going to be allowed as a loss. Well, he must be really disappointed.
But if that is true, if it's a joint trading account, right? If it's a separate trading account?
If it's a separate trading account, they may not know about it, correct? That the brokerage firm will not know about it.
Yeah, if
In
it's a
case,
joint trading account, only then this is a possibility.
no. It is applicable even for separate trading accounts. Otherwise, everybody will do separate trading, na? And then that way they can clearly, fool IRS around this rule. So what they're saying is, then it becomes their responsibility. They have to put it properly. If they don't do it, and in case of any audit, if IRS catches them, then it's like they are into trouble. Because clearly the rule says that within 30 days they cannot do it. They can, otherwise, even if that is the case, forget about joint. If Laura is this person, whatever, or maybe Fred himself is doing it. Okay, buying and selling, and he opens up 5 different brokerage accounts, one with Fidelity, one with Charles Schwab, one with E-Trade. And how would E-Trade know that he's already bought and sold, or like something he has done? So that they will not put that W transaction there, W code. Correct? So that is the case. But then when he is doing the tax return, or when we are doing it, we should at least pay attention what is happening. Is the same stock being bought and sold and all? Does that suffice this condition of being called it as a wash sale?
Basically, it is per investor, not per account, correct?
Yes, it is per investor. It is per taxpayer. So in this case, if we are doing married filing jointly, both of them, they are considered as to be one taxpayer. Because this is one tax return that we are filing with IRS. Right? And both their names are mentioned in that tax return. So they are considered to be one. If they are filing separately, let's say they plan to file married filing separately, or they are like, head of household category they get and all, then it doesn't matter, because there are 2 different tax returns going out. Okay. And another point to note, whenever there is the wash sale, we usually, for the purpose of federal, the software may still be able to do the proper, losses calculations and, put the limit and all. But a lot of times that does not happen for the state. So we'll probably have to go manually and check, like if is the wash sale loss, is it taken as a deductible loss, say for the state of California. Usually it should not. Whatever the rules federal is following for the purpose of this particular topic, states will also do the same. But sometimes we may have to go and manually check. We cannot just assume that we have just put in the W code, like everything will run properly. We still have to do our own check whether, what is state showing now. Federal is showing this much. And because I'm saying that because a lot of times we have noted discrepancy, and sometimes we may have to go manually change it to make them match. Otherwise, California state may send a notice, or some other state, wherever we are filing. Because California numbers will not match with federal. It's very easy for their computers to point this out. That in California, they're reporting a loss of 750, in federal, they're not reporting. So why would California want to give extra benefit of that loss? They may send out an automatic notice. No one is looking into it. Software is sending out notice that as per our information, this is the capital gain category, whatever is not matching with what has been filed with federal. So please, we are going to readjust your income. 750 will be taken as an income, and there's an extra tax liability and so and so. So in order to avoid that, we may have to manually check and all and see whether it's coming properly or not. Okay, so we'll close on this thing now. The entire fourth chapter is also done. Fifth is going to be now. We have probably finished all the above the line deduction. Now we're gonna start with below the line deduction. Shweta, can you tell me what are below the line deductions? What could be those? You can just guess it.
The tax credits, like child tax credit.
No, that comes after the taxable income is computed. We have not even reached to the taxable income part. What happens once the AGI is derived? Then what happens after that in order to come to taxable income?
Ma'am, is below the line same as Indian taxation or like appropriation?
Are you asking me?
Yes, ma'am.
I think Shweta will be the best person to answer that.
Okay.
First I'm looking at the tax.
Yeah, I'm not sure about Indian taxation. Give it a try, Shweta. Otherwise, Tanya, you can help.
QBI?
That's one. Yes.
Uh,
Not everybody will have QBI, right? QBI is not standard. QBI is like only people with S corporation LLC may get QBI.
Educational expenses, medical
So
expenses.
basically, we are talking about standard deduction or itemized deduction. That's what we are talking about. And itemized deduction will cover up all these medical expenses, property taxes, mortgage interest,
Mortgage interest.
donations, all of those things. Yeah, Shweta, clear now?
Yes, yes, ma'am.
Okay, so now I think in the next chapter we're going to focus on all the standard deductions or itemized deduction. If standard deduction is something people can just take away $24,000 of standard deduction. But if they think their eligible expenses are more than $24,000, then they should not settle at 24. Maybe they should go at whatever is higher number, maybe 30,000, maybe 35. Because whatever the deduction is, that will reduce their taxable income by that much. Okay, so there are certain more expenses which are allowed as a deduction, but now those are called below the line. So we'll have to see what is below the line. We are covered, we are done with all above the line. Okay, so we'll close it here.